under that tree that Dr. Carol Knackley has. I know mine is there somewhere. I'll be sending my drone over to pick it up. Uh, Let's kick off by not only wishing happy holidays to everybody, also acknowledging Bahrain Independence Day, 50 years, not an insignificant number, and not that it is a 50 years as a modern state, of course, but it is also a civilization that has been around for a very, very long time, and one of my favorite places in the neighborhood. So Mabruk, Omar, and enjoy the day. Let's kick off with Dr. Carol Knackley, CEO of Crystal Energy. Dr. Carol, the oil markets in Asia are open. Like all other equity markets, they seem to love that Jay Powell is going into a tightening cycle. Before they hated it, now they love it. Any reason to go up, it seems. The general narrative is that the Fed has left the punch bowl at the party and that everybody keeps on dancing. Your thoughts on the Fed decision?
Good morning, Sean. Good morning, everyone. It's amazing. It's been more than a year that I see you almost on a weekly basis. I'm going to miss you, Sean, and everybody else. So I had to get this off.
Just a month, Carol. Just a month to have a nice break.
I'll try to survive with that. Well, look, I mean, it's interesting what happened with the Fed and the market's reaction. You can read it in any way, but I learned a new expression, the Powell pivot, because before his reappointment for a second term, Powell kept on saying that inflation was transitory and it was going to be resolved sooner or later. But actually, he changed tone following his reappointment. And actually, he's talking about, he said, let's ditch the word transitory because it was creating more confusion and maybe inflation is not going to dissipate as they originally thought, and therefore they required some action, some drastic action. However, the market was not surprised by this reaction. Actually, the market was waiting for it because for long people were saying that the Fed was being very lenient with inflation, was not accepting the hardcore fact that inflation is more problematic, more structural than being transitory. And this is where I see the market has welcomed the reaction decision of the Fed. Again, it did not come as a surprise. It was expected, but what was perhaps a little bit more surprising was 3 possible hikes for 2022 for the interest rate. So now we have the speeding up of the bond purchasing, but there is also the hike in interest rate. However, I'd be very careful with the use of term hike because it doesn't mean that they are going to hit the economy and make everyone suffer by simply increasing interest rate immediately very fast. They are going to do it gradually because they want to safeguard the recovery of the economy. And this is how the market is taking the decision of Powell. And that's why you saw this kind of positive reaction to such an announcement.
Neil Atkinson, former head of oil markets division at the IEA. I'm wondering, Neil, I'm not sure if there is a linear line from the oil market to the Fed, but ultimately the markets in general, I wonder if they're celebrating this morning because essentially the Fed has lost the reins of this market. They raise, they don't raise, there's no control. The horse is bolted, so to speak. Your thoughts?
Well, I think we might be being a little bit unkind to the Fed here because we are dealing with unprecedented challenges as a result of the COVID pandemic, and the Fed is criticized if it does this, criticized if it does that. I think Carol has hit the nail on the head there that we are such interest rate increases as we do see in 2022 will be very gradual. We're not going to head back to sort of double-digit interest rates that we saw in the early 80s or in the 90s. It will be very gradual and very careful. And they are trying to understand, as Carol alluded to, how much of the inflation that we see now is indeed structural. And I think we're beginning to understand that it is a lot of it is rather more structural than we first thought. And as policy develops in 2022, they'll adapt their thinking. So I think it's gradual. I think it's welcomed. And the day after a big announcement like this is nearly always, I'm sorry to say, the last time you should try and come up with a definitive judgment. The next few days will be allow a little bit more time for more sober reflection. And we'll get a more considered view from the market as 2022 opens.
I suppose let's welcome Omar Abboud, Director of Research, Bahrain Center for Strategic International and Energy Studies. Omar, the reality is, of course, today in this booming economy, where there is 11 million jobs in the US that are unfilled. The stock markets can't stop hitting their heads against the ceiling, and still interest rates are zero. And still this month, the Fed will buy over $100 billion of bonds. This is still a very loose party.
Yeah, I'm going to be a lot more negative than Neil and Dr. Carroll, I'm afraid.
Join my team.
Let's bring up our favorite Milton Friedman quote: "Inflation is always and everywhere a monetary phenomenon." Monetary policy has been loose for about 13 years now, and it hasn't been showing up in inflation. Now it's showing up. The problem is that the analysis in the public domain is obfuscated by the fact that the Democrats are sense they're going to lose the House and the Senate in the coming year in the midterm elections, and they don't want anyone to panic or to consider any possible adverse consequences for the economy. And so there's this whole facade about how this is purely transient, this is reflective of some supply chain problems and so on and so forth. I'm afraid if you keep on pumping in this sort of liquidity that we've had in the past, it's going to show up in prices eventually. What's been stopping it from showing up in the last 10 years is that it's been going into asset prices. You mentioned the stock prices, the stock market can't stop hitting its head on the ceiling. But now that some of that liquidity is shifting to consumer prices and producer prices. And if we get into that cycle, then it's going to be very painful, and it's going to leave the Fed in a difficult position. And unfortunately, I have to say this, I'm going to add to the criticisms of the Fed. The Fed has become highly politicized when it's supposed to be an independent agency in the US government. In the last year or so, the Treasury, so Yellen, who used to be Fed chair, who's now become Treasury Secretary, the language of the Fed, the language of monetary policy in the US has become highly politicized, and it's quite clear that they're in cahoots with the government, are trying to keep the Republicans out of power. And that means, I'm afraid, rash short-term decisions. This is not without precedent. In the 70s, under Nixon, we had pressure on the central bank, and it wasn't until the 80s that we expunged this sort of politicization of Federal Reserve. But it's back in strength now, and is driven by the political desperation of the Democrats.
Carol, I mean, we haven't talked a lot about this huge debt mountain this year. We've talked about the liquidity and so forth, but we do end the year yesterday with the Senate approving a $2.5 trillion increase in the U.S. debt limit, which pushes it up to over $30 trillion. I mean, the Fed really has no breathing space here. Any percentage increase on this borrowing rate, and the country is practically on the edge of collapse. Bit dramatic, but nonetheless, very little wiggle room.
Indeed. And, I like to finish the year with on a positive note, because I'm in a festive mood already.
But we've still 20 minutes. Get through the nasty, and at top of the hour, get all nice.
Look, if you look around, I mean, you said that the economy is booming in the US, and I thought, okay, it may be booming compared to the deep hole we were into last year. But if you look globally, you see that things don't look that great, because you look at China, for example, the latest macro data has disappointed. Here in the EU, they are also struggling with inflation. You might hear some announcements from the ECB either today or tomorrow with respect to interest rates, and the same thing in the UK. So when you look, and this is only for the developed economies. What about China, of course, but there are also the poorer countries. I was thinking yesterday, people keep on talking about they are focused on the booster rollout in the UK, in Europe, in the US, but they forget that the more you have booster rollout in those countries, the less availability of vaccines can be made to the poorer countries, where the variants of the Omicron and the like are emerging. So we are not out of the woods yet entirely. I would like to say that, yes, we are in better position than where we were at the beginning of the year, but it doesn't mean that everything is going to look very rosy next year. On the contrary, we might have some scarring from the COVID pandemic, from the policies adopted to deal with that massive crisis. And these are going going to be unfolding as of next year, and it started already. So I'm not saying that everything is going to look very good next year. There are some structural problems, what you mentioned about the US, the issue of avoiding some government shutdown or government defaulting is just temporary, and that problem is going to re-emerge again early next year in the US.
Neil, just again, sort of looking through the prism of reflecting on the year as a whole, as we wrap up our last session, the idea that this is still a managed oil supply market. We're still seeing obviously prices rise this morning, somewhat tangentially connected to the Fed not being so brutal. But the idea that as we reflect on the year, it's an oil market that was managed to this $75 handle, and your thoughts on that and its outlook.
Well, if we're getting now down into the weeds of the oil market, I think the OPEC Plus agreement and the OPEC Plus countries have, despite the enormous challenges, done a pretty impressive job if you believe they are directly managing the oil market to the extent that everybody says they are. The price overall this year has been at a Goldilocks price, not too hot, not too cold. As I said in one of these previous occasions, producers have feelings too. And it's not just about the pressure on consumers, it's about the requirements of on the side of the producers to repair their budgets to ensure that they're able to manage their own wider economies in the same way that the consumer governments do. So I think that at the end of 2021, with the Brent price hovering around $70 roughly, I think that in itself is a pretty good place from the point of view of both the producers and the consumers. One final point here, just linking back to something that Omar said. I'm having mid and late 1970s vibes from when he mentioned Milton Friedman and the monetary phenomenon, because I was
it's the anniversary of Bahrain. You got to go back to the 70s.
Yeah, I know. Well, I was 18 in the mid 70s, and I remember all this stuff extremely well. But we're in a situation that of tremendous flux and uncertainty, such as we've never really seen before, other than in times of war. And it makes the task of looking into 2022 even tougher. But I think as far as the oil market is concerned, it's in a pretty good place, although there are some challenges to come from the uncertainty with respect to demand, from any Omicron impact, and of course, the management on the supply side. Although, frankly, what we're seeing as far as the OPEC Plus countries are concerned is that saying you're going to increase production by so much every month is one thing. Managing to achieve it on the part of many of the member countries of the OPEC Plus agreement seems to be something else altogether. And this potential supply issue as we move towards the later part of 2022 could be a major challenge to the stability of the market.
Omar, again, wrapping up sort of the 21, rather, not 22 yet, but 21. We are doing so with the GCC Heads of State Summit in Riyadh. In of itself, a kind of a significant moment given where we've been over the last few years. But I'd welcome your reflections on the journey of the Gulf in its sort of geopolitical alignment or coming back together this year, and ending with the statement, which I think is quite profound, that from a defense pact point of view, an attack on one is an attack on all. Your thoughts on the meaning of all of that, in particular, and its relevance to the Iran nuclear talks?
Yeah, I mean, so the GCC is approximately, I think it's 41 years old now. And with the US withdrawing from the Middle East in terms of active interventionism, in terms of its security blanket, the GCC countries, to be honest, every country in the region is feeling a sense of uncertainty and looking to forge alliances and friendships and partnerships in order to maintain their own security. And that's why you're seeing this sort of quasi-shuttle diplomacy, UAE going to Turkey, UAE going to Iran, Qatar going to Riyadh, etc., etc., etc. So I'm not at all surprised that one of the major conclusions that all sides arrived at is that the GCC, which is an institution which has existed for 41 years and was actually conceived for security concerns primarily due to the Iraq-Iran war in the 1980s, is something that can serve a strong purpose here. There are internal differences, of course, and some of those internal differences persist. But I think, as we've seen from the EU case, that you can have a well-functioning organization, supranational organization, even if there exist significant differences between their member states. The primary concern here is ensuring that everybody works towards a common goal of regional security, and it's and the language, as you mentioned, of the last month. When you had also the Crown Prince of Saudi Arabia, Mohammed bin Salman, going to every single GCC state in advance of the meeting in Riyadh this week, it's all indicating that they want to reinvigorate the GCC as an organization, as an alliance, as a tool to maintain security. And even the language of the Secretariat General has gone back to talking about some of the procedural and functional difficulties they were facing prior to the 2017 crisis. They've been resumed now. So problems with the single market and some of the barriers to economic integration. The fact that that's back on the agenda, a lot of those things were just completely off the agenda for 3 or 4 years due to the overriding concern with the issues regarding Qatar. Now, the fact that they're going back to saying, hey, we need to make sure that there's customs unions working properly, that we can transfer goods across borders without checks and so on and so forth. That's a very positive sign in terms of saying that these bureaucrats are now fixated on the mundane day-to-day life of the GCC rather than, everyone's hair is on fire because there's a crisis.
Carol, as we reflect at the end of the year, obviously the biggest story of the year remains the COVID pandemic as it was in 2020. One would have to sort of bet that it will still to be the biggest story of 22. Hopefully somehow it recedes. But ultimately, my question is, we just saw yesterday, for example, South Korea marks its deadliest day of the pandemic. The UK looks like it's got a tsunami with Omicron. Some of the reports there that it's 70 times more contagious, 70 times more contagious than the previous variant. But ultimately, my question is, as an economic disruption over the course of the year, have we got to the point where the global economy can coexist with COVID and still, near full employment in the US, in the UK, and so forth? How big of an economic disruption is it still today as it was compared to the beginning of this year?
We are in a different situation today, Sean, because we are learning how to live with the virus. The types of lockdowns, the restrictions that we saw when the pandemic first hit are unlikely to be repeated, partly because people are not going to follow those, they are not going to accept them, and we see how they are protesting in Europe at least, or even the UK without doing any protests. They are simply refusing to follow the government rules, even though they are mandatory. They are not wearing masks on bus, they are not wearing masks in shops. So you can see the kind of rebellion from the people. But second, and more importantly, we know how to deal better, much better with this virus than we had, for example, the situation of early this year or last year. So we're in a completely different ground. And therefore, I don't expect to see major economic disruptions. What we're seeing in terms of restrictions, if you notice, they come with a deadline. So they say for the next 2 weeks, for the next 3 weeks. It's not like open-ended restrictions. And also governments don't want to go through this vicious cycle because there is no need for it. Yes, the rate of infections are rising, but the rate of death is not rising at the same speed. I think the UK, even though they had the highest infection rate recorded yesterday ever since the beginning of this pandemic, we don't see that coincided with an equally dramatic figure for death. And this tells you, and there will be also more vaccine, more treatment. Pfizer talked about, announced that it was one of its the pills it developed is working very well in terms of treating the virus. So we are actually moving into the natural process of living with the virus, and hopefully 2022 will mark the end of the pandemic. It will be more like an epidemic, like the cold virus, like the flu virus. But I doubt we're going to see the economic repercussions that we saw earlier this year now with these temporary restrictions that are being put in place.
Neil, we end the year with the inventory report yesterday. Another stock draw. Oil prices rose yesterday. Coming back to the fundamentals of supply and demand, where do you think we end the year? I mean, we had Vitol on our halftime talk show this week, Chris Bake. If Vitol's sort of piece is that we're back to pre sort of COVID levels on demand side, where are we, do you think, in the supply demand balance at this point, and how much excess or leftover supply do we still have to bring back?
Well, I mean, the fundamental data has been showing for several months now that on the assumption that that demand remains on a steady path, and on the assumption that the OPEC plus countries continue with their agreement, there is a recovery in supply to some extent from the United States and some growth. There is growth also on a more modest scale in countries such as Brazil and Norway and Canada. And those fundamentals have pointed for some months now that as we move into 2022, there will be a surplus of supply over demand. This is nothing new. This is not a shock. And my former colleagues at the IEA reinforced that message yesterday. So, you know, as far as the 2022 outlook is concerned, I believe that prices will remain relatively subdued in the early part of 2022. But as we move through the year, if demand does continue to recover and it is not hit by a further mutation of the coronavirus, then prices should recover, and then we start to hit some issues about availability of supply beyond what we currently expect to see in 2022. And that's a big discussion for another time about investment and all the rest of it. Just one final quick point. I picked up on something Omar said, which I thought was very perceptive. As far as the US is concerned, oil policy is concerned, to the extent there is an oil policy, all they care about is maintaining control of Congress in 2022. All they care about is making sure that US gasoline consumers, around whom the world seems to revolve as far as the administration is concerned, are not hit at the pumps, and they will do anything in 2022 to make sure that that price remains low. And finally, Carol, I wish I could be as optimistic as you, though I understand where you're coming from, but please pray for me. I'm going to London today for 3 days, and Plague Island, and frankly, I wish I wasn't. But I'll be back.
It's not Paris. Love Island. It's not Castaway. It's Plague Island with Boris, your ringmaster. Let's go to the survey of the last survey. Everything's the last today. The big question is, and I suppose the big answer for next year: can the Fed slow inflation without derailing growth in 2022? That's the challenge they have, and that's my question to you. Can the Fed slow inflation without derailing growth? And now we'd like to get everybody's sense of where tomorrow looks. You know, the crystal ball 2022 outlook. Omar, we have in our neighborhood and in your neighborhood the big question of the Iran nuclear talks ongoing. And so we talked a little earlier about this activity of regional rapprochement politicking, and we have the Iran talks. Where does that all end up, do you think, in 22?
Well, just picking up where Neil was talking, I mean, Biden has made several huge miscalculations when it comes to foreign policy. The first is he completely misjudged the Iranian position regarding the nuclear deal, and the nuclear deal is not going to be resurrected. It's dead. And he's painted himself in a corner, and he looks even worse now because he was very sort of forthright in claiming that when he was on the election path that we're going to get Iran back to the negotiating table, we're going to get those extra conditions that we need, we're going to widen the scope of negotiations. And Iran's just laughing at them because he's fundamentally overestimated Iran's need to re-enter, to achieve it, to strike a deal. And Iran's just basically saying, you guys do whatever you want. And it's humiliating the US in the way in which negotiations are proceeding. And I can't see it.
On that point, Omar, is it taken that that point you just made.
Yes.
Should we? How do we then interpret the regional dynamics? The UAE going to Tehran, is that it, with the understanding that this new, I would read it on one level, oh, that means the nuclear talks are in good shape, that'll get to the destination, or is it the opposite? UAE is finally saying there ain't anything happening there, so we've got to actually do our own thing.
So if we were in the 1970s with Milton Friedman, let's go back to his forefathers, the classical liberals.
When Neil was on, his hair was a little longer. He was on his motorbike. He was hitchhiking to Glastonbury. Yeah, I can see the picture now. Yeah.
So if we go back to late 18th century, the classical liberals were saying, look, the way to peace is through trade and economic integration. One of the main outcomes of that trip by Tahnoun to Iran was a deal to build a power plant in Iran by, I think it was a solar power plant by the UAE. In Egypt and if you'll notice in Saudi Arabia are integrating their grids and there's some sort of electricity exchange. There was a deal between Egypt, between Israel, UAE and Jordan over solar power. Power is driving Iraq and Saudi Arabia are trading energy as well. So I think what everybody's arriving at, the conclusion that everyone's coming to is the Iran deal is dead. And we're going to need to make a new regional order and let that regional order in the classical liberal tradition be led by economic integration, which will make war and conflict costly for everyone and therefore hopefully yield a more stable outcome than the previous one, which involved people boycotting each other and people not refusing to trade and isolating each other. That's the plan. Whether it succeeds or not is a separate issue, but it's definitely a lot better than hoping for the Americans and their bumbling foreign policy to realize any degree of regional stability.
Neil, your thoughts on what do you think will be the biggest driver potentially for oil markets in the new year? What will you be watching?
Well, the uncertainty obviously on the demand outlook, which I'm a little more pessimistic, I think, than Carol. That's the main thing. And where does
China sit in that, Neil? Where does China sit in that?
Well, Carol referred to some disappointing data out of China, and that's a point that is very well made indeed, because China obviously is now by a big distance the second biggest oil market in the world, and we're going to have to watch that very carefully. So the short-term issues over the demand outlook, but the bigger picture issue, which will be important in 2022 and post COP26, we're already starting to talk about this, is the issue of continued investment or insufficient investment in the upstream oil and gas sector as we try to bridge the current energy structure to reach the goal of the net zero energy economy. So I think investment is going to become a big issue in 2022.
Well, as OPEC Plus runs out of new oil to bring back, there might be a tightness. Let's get the survey result and give Carol the last word on the last podcast of 2021. Can the Fed slow inflation without derailing growth in 2022? No, is the answer in this room. Your thoughts, Carol, what 2022 to look out for? What do you think of the answer to that survey?
I think you guys have to move to the Black Forest for a few days to lift up your spirits and your mood with all the lights around, because I think there are lots of pessimism in this.
I would love to. I always have a lasting memory of my one Christmas I spent in Germany, which I'll never forget, because they had live candles on the Christmas tree. And I was like, my goodness, how amazing that. Live candles on the Christmas tree.
Yeah, that's what my dear husband wanted to do, but I don't allow him. Otherwise, we're going to set the whole house on fire.
The whole of the Black Forest on fire, not just your house.
And you will hear about it for sure. Now, look, I mean, again, lots of uncertainty surrounding 2022, and we are yet to see what's going to happen, whether in the economy, whether in politics, whether in oil markets. But you cannot deny that at the moment, you can see the Biden administration for the US is actually riding on the, they're trying to trumpet the fact that oil prices are where they are today, thanks to their announcements of the SPR. And you can see that with their publications. They tell you that today oil prices, Brent, is $10 $10 below than when the president made the announcement of releasing the SPR. Gasoline prices are lower. So when you go to fill your car at the pump, you pay much less, you feel less pain than when you were doing that a month ago. So there is some kind of relief or improvement at least in major economies such as the US. And again, with the coronavirus, it is still there, but people are tired of restrictions. They feel they got the vaccinated, we got the treatment out there. So we don't want to go down the route of lockdowns and restrictions. At some point, maybe all of us will have to get the virus one day so that, you build immunity, as many people believe that. But overall, in terms of oil markets, there are no many major surprises there because we were already expecting more supplies next year. The high prices, this rapid, impressive recovery in oil prices could not but bring more supplies to the market next year, whether from the US or the various countries that Neil include now to add to that list, Guyana, for example. So in terms of dynamics for oil markets, it's more about the fundamentals of mainly more supplies coming into the market. How will that play out? And also for the demand recovery. But I'd like to finish this show on a positive note and wish everyone a Merry Christmas and a Happy New Year. And we'll see you next year, hopefully.
Well, you will absolutely. The Daily Energy Markets podcast will resume on Sunday, the 16th of January. But ahead of that, we will have our annual UAE Energy Forum at NYU Abu Dhabi, New York University Abu Dhabi. And I do hope as many of you that are in country or if you're in the neighborhood, please join us. Dr. Carol will be there, I know, and some of our other regular commentators. So please, you are most welcome if you are in the neighborhood or in the country. January 12th at NYU Abu Dhabi. That wraps it up. Oil prices trading firmly in the mid-70s as Neil Atkinson captured it. The Goldilocks spot, not too hot, not too cold. Every producer and consumer can go into Christmas happy enough that the world economy is in decent shape with an oil price that isn't putting too much pressure on anything and giving enough revenue for new supply, if indeed one wants to invest in it. That's the big question. Not that the money isn't there, but whether you want. Somebody said to me the other day, why would you buy a combustible engine car when you know in 3 years you won't be able to sell it? Nobody will buy your combustible engine car in 3 years. That was a thought. Maybe somebody will somewhere. But anyway, Merry Christmas. Thank you, Carol. Thank you very much, Omar. Thank you very much, Neil. All the best. Omar, did you want to say something?
Yes, Neil and I have been invited to a party at 10 Downing Street for Christmas, so hopefully that will lift our spirit.
Oh well, best regards. I'd wear a mask if I was you.
You've outed me. Down.
all the best, guys. Merry Christmas. Thank you so much, and we'll see you in the new year.
Thank you.
Salama. Thank you.